I've always talked about China and they having problems with their economy, or its country having problems. But now I want to look at Japan and the Nikkei crash, and I wanted to get into that and compare China and actually what happened with the United States and their crash. And what I did is I made a graph of the Nikkei against the yen, Japanese yen, or dollar yen chart. And if you look at the yen in 1971, where this chart begins, so $1 would get you 350 yen. Right now, it's like 102 yen. So we've seen a huge appreciation of the yen since 1971. Okay, and in the blue, that represents what the value of the Nikkei was. And if you can see one interesting point, we had a slow but steadily increase in the Nikkei, which corresponded with a slow but steady appreciation of the yen. So if the yen goes down from like 350 to, I don't know, 200-ish, right? That means that the yen is appreciating, even though it's going down. So some people may be confused about that. But let's just look at this graph again. And I want to go to 1981, or excuse me, 1985. What happened in 1985? We had the Plaza Accords. The Plaza Accords basically had the United States debasing their currency while the Japanese currency would steadily appreciate. The problem with the Japanese currency, just like we're seeing with the Chinese currency, is that many people complain that they had an artificially low currency. Doesn't that sound like China? People say that, hey, they have an artificially low currency, which is helping their exports. Just as a disclosure, I believe that countries can have a strong currency and thrive, but in order to thrive and their manufacturing sector to thrive, they need to cut spending, they need to cut taxes, they need to get rid of all these rules and regulations. But we don't live in that sort of paradigm. We live in a paradigm where people think that having a weak currency will stimulate its way out of its mess. I mean, in the short term, they could have a weak currency and get away with it, but in the long run, they won't, in my opinion. But that being said, what gave Japan one competitive edge was that they had an artificially weaker currency, and there were other factors as well that helped them grow their economy. Don't get me wrong. They saved and invested as well. But the main point I wanted to get at in this graph is that what happened in 85? So the dollar would depreciate while the yen would appreciate. Well, here's what happened though. All right, $1 equals 250 yen in 1985. What happened in roughly 1989-ish, right? Around that time where the Nikkei peaked. Let's just say 150, okay? 150 here, and the Nikkei was 36,000. So what percent decline was that? Let's get the calculator out. So 250 minus approximately 150. So roughly a 40% decline. Excuse me, not decline. It was roughly a 40% appreciation of the yen. That's a huge move within a span of 4 years, right? A currency appreciates 40%. And what happened with that? As you saw the currency appreciate, you had hot money flowing into the Nikkei. And you saw the Nikkei go from roughly 12,000-ish to 35,000. So let's do the math. So 35,000-ish minus 12,000. These are just approximate numbers, by the way. So that's a 191% increase in the Nikkei, while the currency appreciated 40%. And then eventually the Nikkei bubble just burst out of control. And now I want to go to the Chinese chart, the Chinese yen. I wanted to show you a few things from that. So here's just a graph of the yuan. So $1 right now gets you like 6.21 yuan, something like that. And I want to look at the chart since 1991. That's when you had the liberalization of the Chinese economy. I mean, you had the fall of the Soviet Union, so we started to see China implement a little more free market economic policies. Then in the coming years, you saw the yuan usually float around $8, right? So $1 got you $8. And as of 2003 to 2004, I'm sorry, not 2003. It's roughly around 1994 where $1 got you 8.63 yuan to roughly 2004, 10 years later, $1 got you 8.27 yuan. So what the Chinese had, they had a stable currency. Sure, it was rigged and manipulated. And the way that the Chinese thought was that, hey, you know what? We could kill two birds with one stone. And how they did that, or going to the Chinese mindset, they wanted artificially low currency, just like the Japanese is in the 1970s, as I showed you. And what happened was that they had a weaker currency which allowed them to stimulate their exports. And they also saved and invested as well. So that's what enabled their manufacturing base to grow. But they were pressured by Western world, just like the Japanese were pressured by the Western world to make their currency appreciate. And now they're taking slow but steadily steps over the past 10 years. So the yuan has gone from $8.27 to roughly $6.21. So $1 used to get you like 8.27 yuan. Let me rephrase that, yes. And then now, $1 gets you roughly 6.21 yuan. And I've done videos about the credit markets in China and the potential crash. And the way that I see it is, we could potentially have some wild fluctuations before this Chinese bubble bursts. And my reasoning is what happened in the Nikkei and what also happened in the United States market. So whenever you see these bubbles form in these westernized countries, you tend to see crazy amounts of moves towards the end of that bubble. So now I see this article last week on the Business Insider. It says Chinese yuan has fallen to a level that means real pain. And I could go at it right now. Chinese yuan has weakened to a level that has some folks sweating. The offshore yuan exchange rate has fallen to 6.2 per dollar. That comes after the policymakers announced that it would allow the yuan to swing more freely each day. The yuan has only weakened since the announcement. As you can see in the chart to the right, it takes increasing amounts of yuans to get a dollar. 6.20 is a particularly worrisome level for the 300 billion structured financial products market. For CNH, the 6.15 to 6.2 zone is critical for structured products, above which a topside move could become nonlinear. So what it means is that as long as the CNH stays between 6.15 and 0.620, neither party is getting crushed. Okay, long story short in what they're trying to say, there are obviously a lot of people on many sides of the trade. And you also have to look at the fact that Chinese is having subprime problems. So if you see a lot of speculation going on in these currency markets, derivatives markets, etc., subprime, in my opinion, if you see the yuan go in either direction, to the upside dramatically or downside dramatically, it's going to create dislocations. Because obviously we've had an extended rally in China, which has been promoted by big government policies of China. And eventually, we all know what's going to happen. It's just going to go boom shakalaka. And I wanted to show you one last thing. Alright, I want to show you just a trade-weighted index of the dollar. It's not exactly the same as the Dixie dollar index, but it's real close, just as a disclosure. And I wanted to show you just a few things, right? When you see dramatic moves in the dollar in the currency markets, you tend to see some dislocations within our economy. Notice under Reagan and Volcker, the Dixie index reached close to 150. And then all of a sudden it went down close to 50%. Dollar index close to 50%. What happened in the 1980s? You had that crash of 87, right? So from peak to trough here. And if you want to go from over here, 2000-ish, right, to roughly 2008, peak, trough, right? Dollar index close to like 110-ish and got close to 70. What happened there? You had dislocations within the economy. You had a strong move to the downside in the dollar index. We all remember that. What happened? Higher oil prices, higher commodity prices, etc. So when you start to see ridiculous moves to the upside or downside in currency markets, that should be, in my opinion, a signal that you're going to have a lot of problems emerge. But you have to look at this though. It did take some years for the crisis to brew out. I mean, not the crisis, but for the moves in the currency markets to play out. So that's something to know. But if you do remember in 2007, the moves to the downside in the dollar, a lot of people are saying, hey, this is going to be hyperinflation, this and that. But we didn't. We had actually a deflationary head fake in 2008. So this is something to note. Like I've said, I do believe that China is going to be one of the big shoes to drop within the next few years. And I've already noted what's going on in the subprime markets, what's going on in the LIBOR, not the LIBOR, but the SHIBOR markets. None of these banks want to lend. And another clue probably, in my opinion, in the next few years is going to be wild fluctuations in the currency markets in China. They're trying to stem hot money from coming in. They're trying to let the yuan float. But if they do that, there's going to be some other dislocations when it comes to that. A lot of traders are betting that the Chinese yuan is going to appreciate. What if it depreciates, right? So the Chinese have a lot of problems on their hands. Let's see how it's going to play out. But like I said, I've already noticed a few signs in the credit markets. Now, what's going to happen in the currency markets? We shall see. I think they're going to be wild moves. What do you guys think about this? Let me know. Talk to you later. Bye.